The answer to that is no. If you put money in any environment that earns below the inflation rate, which is effectively what you're saying, you're effectively taxing future consumption. Now, that may feel better initially, but over the long term, you're far worse off. Your savings are being depleted without you actually even knowing that. But I think the bigger question that you're alluding to is how do we as an industry make clients enjoy the ride so that they can invest for the long term in slightly riskier assets, but be able to stick around to get the long-term return that avails itself to. When you look at the world and you've got China slowing down, the US bumping along at a very low growth rate, and Europe almost looking like it's on the edge of the cliff consistently, it's very easy to retreat. However, the answer isn't to retreat. The answer is to create a smoother return profile, to allow clients to enjoy being exposed to those assets that allow them for the long-term return, but not having the scary intermediate bumps along the road. And more importantly, if you can invest selectively and where opportunities exist and provide themselves, then you don't have to invest in everything and take all that risk. You can just go where you think the most opportunities avail themselves to. An economy, and the global economy in particular, is a very complex system. It's very hard to know how things are going to unfold. There's too many variables involved. So what we can do is bring it down to the basics. We know a few things with a fair level of certainty. One, we know the world is deleveraging. What that means is there's less consumption, less investing, more saving. And that leads to lower growth, lower sales growth, lower earnings per share on the equity side, lower asset price appreciation, which is an unexciting scenario. On the other hand, we do have governments reacting to that, and what they're doing to a fair extent is they're printing money where possible. So you have it in the US, Japan, UK, Europe's now coming to the party. And now what printing money, which they call it different words, but what that effectively does is it provides liquidity to some extent where liquidity is being drained away. It supports asset prices. It tries to promote risk-taking. So when you put those things together, you get an outcome that's probably a middling type scenario. So the catastrophe of things falling off the cliff has probably been taken out because policymakers are probably more aware of the issue now and more awake to the possible solutions. And printing is one of those. And on the other hand, the strong recovery that you get post-recessions, which has been quite consistent since World War II, is to a large extent unlikely because we're now in a deleveraging cycle. So what that leaves, as I mentioned, is probably a low growth bumping around the bottom, but at a stable growth, low growth environment. But because that isn't a scenario where a rising tide raises all boats, it does mean you have to be very selective and very careful about where you allocate your capital. We think a lot of opportunities still exist within international markets and the equity market in particular. However, the biggest challenge we have and investors have is that markets are volatile. Sometimes they go up and down, and sometimes they actually go nowhere. And that's been a recurring fact for the last probably 5 to 10 years. So one of the solutions that we offer is we provide a smoother return profile, as I mentioned. We provide ability to get paid for taking risk. Now, we also provide the ability to earn a decent return even if the markets go nowhere or are flat. Now, how do we do that? We do that from two sources. On the one hand, we have access to capital gains and dividends through the shares we own. And two, we use a unique implementation approach which uses options as a means of implementing the shares we want to buy, and that delivers an option premium. Now, that premium is there regardless of what the market does. So it's the combination of the capital gains from the shares we own and the option premium from the implementation, which together delivers a return profile that gives you most of what the market does on the up, gives you far less of when it drops, and it gives you a return even in a flat market. And over time, that delivers a very smooth return profile.